morning, everyone, and welcome to the Business Owner Strategy Forum. We're up to week 13, which is quite amazing. I'm your host, Matt Murphy. I'm the managing partner of Prime Accounting Business Advisory, and we've sort of had the pleasure of bringing this forum to everybody over the last 13 weeks and sharing great content. And for the reason why we put this together in the first place really is to connect, share, and support business owners through, the turbulent, difficult times that we're going. But we've continued on with this particular forum because we thought, we had great feedback and people were really enjoying listening to the content that we had and the great speakers we've had over 13 weeks. So we just decided we're going to keep it going. So these were the topics that have been covered so far in the last forums, and they've been great and presented by wonderful speakers as well. And so today, we've once again got a great speaker from Investible, which is an early stage fund, and it's Daniel of Veytsblit, and he's the investment director. And Daniel is going to provide us with great insights today in terms of, what he does is his main role in that job as the investment director. And so he'll take us through that a bit more, but just from an introductory perspective, that he looks at lots of different organisations every year, like businesses, probably about 2,000 a year, I think, and what his job is to work out which ones he believes attractive to capital and investment worthy of the money the investors have put into the fund. So from that perspective, I think we're going to get some great insights today in terms of, not only what makes a company attractive to capital, but what makes a great company, and what are the attributes and the formula that actually means you've got a greater chance of being successful than not being. So, I'm looking forward to listening to Daniel today in terms of giving us those insights. So I'm going to welcome Daniel onto the forum. So welcome, Daniel. How are you?
I'm well, thank you, Matt. I appreciate the opportunity to present on the topic today.
That's great. No, I really appreciate that. And obviously, we've had been connected together for a number of years now in terms of the fund, and also in terms of your role previously at Prime as well. So it's been a good relationship in terms of that. And I've really enjoyed talking to you over the years in terms of your insights into business and from the perspective of, as an investor. And from a capital perspective. So I've really enjoyed that from that perspective. And that's why we invited you on today, because I think you've got an amazing insight into business from that lens. So so thank you for joining us today. And I'll hand the reins over to you in terms of presentation, and we can have a chat along the way.
Excellent. Thank you very much, Matt. And I've also enjoyed my interaction with yourself personally and Prime over the last number of years, and hopefully I can share some of that insight into what we look for in businesses today in this short presentation. Let me just share my screen, and hopefully you can see a nice ski field there, which will now turn into a presentation. Let me know if you can.
It hasn't been shared yet, Daniel.
Oh, okay. Hang on.
Oh, it's coming now. Yep, got it now. Thank you.
Is that on the screen?
Yep.
Perfect. Excellent. Well, good morning, everyone. Before I begin on the topic at hand, which is what we look for in early stage companies and companies that are raising capital, I thought it would be useful to provide a brief summary of Investible, who we are, what we do, and how we do it. I'll go through this part of the presentation pretty quickly, but I'm happy to take questions at the end on any part of the presentation. So Investable's mission is to provide high potential founders intellectual and financial capital needed to scale. The financial capital part of that is pretty self-explanatory. We invest cash into early stage companies. The intellectual part of that statement focuses on our belief that we need to be active investors, more than just cash, and provide support framework to founders to help them scale and succeed. This includes support via our team, our which is a group group of 60 plus individuals and family offices across Australia and Asia, and their networks, as well as peer-to-peer support frameworks. We've got offices in Sydney and Singapore, and invest in seed stage technology and technology-enabled companies on a sector agnostic basis, ex-biotech. We were founded by Trevor Folsom and Creel Price, themselves entrepreneurs who co-founded Blueprint Management Group back in 1998 and scaled it until exit in 2008. So we do have that entrepreneurial DNA in our company. We have a track record of investing in seed stage tech companies that dates back to 2010, and have invested in companies in 8 countries across 4 continents. Our investment club, our syndicate, has made 74 investments since 2010. That's yielded a compound annual return of over 60% per annum, returning 4 times cash back on investments prior to 2015. Early stage investment is not without risk, but we're proud to say that only 15% of the companies that we've invested in have failed. Anecdotally, anywhere between 60 to 90% of companies founded fail. So that 15% is something that we are very proud of.
They're phenomenal statistics. Every time you present those statistics, I always look at them and go, they're pretty phenomenal. To invest into early stage and have that strike rate is pretty amazing.
It is, and I'll try and share the kind of formula, the art and science of how we do that later in the presentation. As Matt noted, we launched our first fund in 2018. We've deployed almost $7 million of that fund into 22 portfolio companies, and are still investing from this fund today. To do early stage investment well, we believe investors need to do 5 key things well. They need to be able to source the investments, screen them, obviously secure them. Just because you have capital doesn't mean the founders will take and want your capital. You need to be able to support your portfolio companies, and you need to be able to do all of that at scale, because we think diversification is critical to investing at an early stage. My presentation today will focus and hone in on the screen stage of this process. Apologies. And the screen stage of that process uses the Investibility Index to assist with screening all of our potential investment opportunities. The index comprises, as you can see, 17 different factors that are assessed when screening an opportunity. And at the heart of every opportunity is the founder or the founding team. At our investment stage, we're really backing people to execute. We collect as much data on the opportunity as possible, but this data is typically different to the data you would obtain if you're investing in a listed company, as an example. There isn't 3 years of trading history. And we use this data to assist with our process. Rather than going through each of the 17 factors on this slide, I thought I'd provide some examples of portfolio companies and some of their characteristics and what makes them attractive. And hopefully you'll see some common themes coming through, but I'm obviously happy to take questions on any aspect of the Investibility Index.
Just for those questions, if you want to put them in the chat, that's fine. Sorry, in the Q&A button down below, that's fine as well, as normal.
Yeah, and happy to take those, Matt, as we go or at
Sure.
the end of the presentation. So the first company I wanted to talk about is Monetis. We invested in Monetis in 2017. And at the time, they operated a direct-to-consumer seafood delivery service in Sydney and parts of New South Wales. They've since expanded the company to launch a global B2B wholesale marketplace that delivers seafood direct from the fishermen and cooperative to wholesalers globally. And that's the part of the platform that, frankly, we are excited about. Now, as I said on the previous slide, at the heart of every opportunity is the founder. And we wouldn't have made an investment in seafood tech, which is obviously a very niche sector of tech, if it had not been for the founder, Peter Menettis. Peter's family has been involved in the seafood industry and the Australian fish markets since pre-1900. And Peter himself has been involved in the family seafood business pretty much since birth. His knowledge and relationships in the market create a competitive advantage in a market that's relatively tech-free and based on old school relationships. This isn't a business that, whilst technologically isn't particularly sophisticated at this stage, and that is changing, this isn't a business that a savvy software engineer could create because of the industry, and because scaling a business of this nature really does require deep relationships and connections within the industry. And so this is Peter's competitive advantage.
It's really interesting when you look at that, because you wouldn't sort of think, if you're investing in the early stage, sort of predominantly tech businesses, you'd be thinking about seafood. So it's great that you explained, part of the rationale as to why you would invest into this particular business as opposed to other ones.
Yeah, exactly right. It is centered around the founder. Now, the technology platform does play a pretty vital role, because using it benefits both the buyers and the sellers by removing fee-taking middlemen, increasing the efficiency of the produce, getting from the fisherman to the wholesaler and then ultimately to the consumer, and also focusing on traceability and sustainability of the produce, of the seafood. It's a pretty simple business model in which the business takes a fee for facilitating a transaction. So there's nothing complicated there. And the other thing we do like about it is that it's globally scalable. Since launching Shore Trade, which is the B2B platform in May 2019, it's already facilitated transactions across Australia, Asia, and the US, and between those three continents as well. So those kind of 5 factors are key to what we like about this business and why we believe it will do well going into the future.
Its performance so far has been good.
Yeah, the performance has been exceptional so far. The B2C side of the platform adjusted during COVID-19 and actually expanded its range beyond seafood, and delivering meat, bread, pasta, fruit and veg direct to households in Sydney and along the Central Coast. Soon to be Melbourne as well, I think in the next couple of weeks. Menettis will be online in Melbourne, and then hopefully we'll expand around the country. On the Shore Trade side, the B2B side, the platform was launched in May 2019 and trades around $3 million a quarter already, which is pretty significant traction just 1 year after launch. And that really has been due to the ability of Peter to be able to secure supply for the platform through his relationships.
So one of the good ones that you picked so far, so you'd be pleased about that, no doubt, Daniel.
Absolutely. And there's hopefully more good news to come, which we can share publicly over the next couple of months. So stay tuned for that.
Cool.
The next business that I wanted to talk about is AEV, a very different business to Menettis. So AEV is creating autonomous low-speed electric vehicles, and they really redesign and reimagine the way that a vehicle is built. Again, at the heart of each great business and great early stage business is a great founder, and Julian Broadbent The founder and CEO is a former director of innovation at GM, General Motors. Spent 18 years in various roles at GM, and has also worked in Silicon Valley, more recently working on autonomous vehicles. So that's part one of what we like. Part two is the vision, and the vision has reimagined the way that vehicles are produced, and it's not encumbered by the way that non-autonomous, non-electric vehicles are produced. As you can see from the picture, the concept is that of a uniform base with customizable pods built by consumers to fit on top based on their use case. And we liken it, and AEV likens it a bit to the iPhone, where you have a pretty standard base iPhone that comes as a piece of hardware with software on it. And then you've got a large number of customized apps on top that provide functionality. And similarly, the AEV base will be able to provide different types of functionality. So whether it's on a mine site, whether it's delivering pharmaceuticals, whether it's in a retirement village, there's a pod that can clip onto the base and be programmed to complete its function. There's obviously a pretty high barrier to entry in this space. Again, not every software engineer or not every visionary or commercial person can just go into autonomous vehicles and understand or even envisage how to create one. And the product is globally scalable. So these guys have had, in terms of a little bit of traction, they've had 4 versions of the base that have been commercialized, and there, I think, are 5 vehicles out in use at the moment. V5, which is the version that you see on the diagram, is due to be launched in September, and they're in deep discussions around a number of use cases across different sectors at the moment. So a very exciting opportunity, obviously much more futuristic potentially in many people's eyes than the seafood tech example, which is live, more tangible, more understandable.
Well, what I liked about it is that you're actually using a similar formula to work out what you invest into, whether that's sort of, and they are very diverse examples of what you invest into. The one about this one, though, obviously, in terms of speed to market, there's going to be, I assume it's going to be based around sort of countries allowing this type of transport to occur. Would that be fair to say?
Yeah, absolutely. The regulatory environment will play a factor. The differentiator here is that AEV is focusing on low-speed vehicles, vehicles that can drive 40 kilometers and under, and also can go off-road. And so the regulatory environment around those type of vehicles is not as strict. So we'll likely see the first use cases being for non-passenger vehicles, again, where regulations are not as strict. So the time to market can be a little bit shorter than if it were a passenger vehicle only autonomous electric vehicle.
That's cool.
And then the final example I wanted to talk through today is Jigspace, a very different company to both Monetis and AEV. And Jigspace's mission is to be the PowerPoint of spatial or 3D computing. Founders Zach and Numa have a very complementary skill set. Zach coming from a video game and art design background, and Numa having over 10 years of development and software engineering experience. There's a huge vision there. If you understand how ubiquitously accepted PowerPoint is, the vision here is to become the PowerPoint of 3D computing. So imagine going through something step by step in 3 dimensions versus 2 dimensions. The other I guess, unique aspect is that Jigspace has developed a unique relationship with Apple, which has seen Jigspace used as part of iOS launches over the past 3 years. And the Jigspace app is actually installed in over 150,000 Apple stores worldwide. That's both the free version and soon to be the paid version, which actually was just launched last year. So there's been about 2+ years of development to be able to get the granularity and the tech to work smoothly, so that it can work as smoothly as PowerPoint, but in 3D. Obviously, this is globally scalable, and we look forward to seeing adoption rates. Anecdotally, not so much anecdotally, actually, over the last 3 months over COVID, there's been a theme of knowledge sharing, and Jigspace is particularly useful for sharing knowledge around complex products. Think about things like trucks, think about things like ventilators, where they've got a customer in that space at the moment, and other kind of complex machinery where it's hard to actually bring that machinery on site every time. So having a 3D PowerPoint to be able to explain that piece of machinery is extremely valuable.
Yeah, once again, really interesting that, looking at the formula, because that's kind of what we're really focusing on at this particular point in time, because not every business is really looking for capital at the end of the day, but every business is looking to grow and develop and maybe one day exit. And really, the principles that you're applying here are the principles that we should be all thinking about in terms of, our business's ability to achieve the reasons why you went into business in the first place. So the ultimate sort of dream or aspiration and vision. So it's good to sort of make that point too, that it's not just we're explaining this for the purpose of trying to seek capital, but really to build great businesses.
Absolutely. And I think I've spoken with Matt and many others that are advisors and people that are seeking to raise capital, and said that, seeking any form of capital, let alone VC capital, is not for every business, and is not appropriate for every business. And in fact, revenue, if you can get it without capital, is the best form of capital itself, to fund the business. So I think that point is super important to be making, that not every business should be seeking capital, but the foundations of great business are probably similar across every type of business.
Cool.
So I wanted to get into very quickly as well, investing in a downturn.
Yep.
Obviously very relevant over the last 3 months, in particular, and even more so probably given what we saw in markets yesterday, and overnight, in terms of which way people may be thinking going forward. So if you look at kind of previous downturns, you'll note that during the GFC, as an example, there were over 50 tech unicorns founded, and actually the time for them to reach a $1 billion valuation was shorter on average than companies that were founded in years prior. There's some pretty significant businesses that we all know, the likes of Slack, WhatsApp, Uber, Dropbox, etc., that were founded during the GFC. And I think the reason for this is that downturns can force founders and companies to think a little bit differently, to perhaps pivot, to focus on what customers, consumers, and businesses actually need. And obviously to do this in a very capital efficient way, because in a lot of cases, capital does dry up during a downturn. And I think the other point to note, and you can see this recently, is that tech is not only attractive long-term because of the disruption, but in many cases, and in particular in software as a service businesses, it's attractive because of the predictable revenue, the positive unit economics, that come with businesses of this nature, and I'll just explain that. So when we talk about unit economics, we talk about revenue being derived from customers over time that is significantly larger than the cost of acquiring that customer. And businesses like that can afford to increase spend on marketing sales, knowing the return is going to be, the return on investment is going to be high. And that's why we've seen over the last 3 months in particular, the NASDAQ outperform the S&P, while we've seen potentially at SaaS multiples increase from just over 6-7 times to over 12 times for listed companies in the US. And then I also wanted to, sorry, go ahead, Matt.
Sorry, Daniel. One of the things I was just going to highlight then, it's a really good point to make around the fact that, you know, you said that, especially in those times, businesses have got to pivot. They've got to think about what the customer wants and be efficient with capital. But I think that there are points that really should be sort of highlighted, because adversity brings you into this situation where you're under stress and you've got to think about how you're going to use efficiently what you've got to be able to get a better result. And I think that they're really good points that you just made then.
Yeah, absolutely. I mean, efficiency is key in all times. During a little bit of a bull market, you may think that there's more capital around, but obviously in a bear market, you've really got to watch for how you use the capital. And that's what I'll go into now in terms of what we look for today for any businesses that are seeking capital today. So we're a long-term investor. So we use the same process and same factors today as we do any other time. We invest for a 5 to 7 year hold period, and believe that companies need to be able to perform through the cycle. There's probably a further focus on tech that's a necessity versus a nice to have, you know, the old vitamin versus painkiller in terms of tech. But we don't try and time the market in the short term. We're not an equity investor that trades. While we're cognizant of long-term tech adoption trends, we're not trying to time the market within a single year, as an example. So what are we looking for in particular within these kind of 17 factors today? And I think the first thing, whilst I highlighted the founder as being at the heart of every investment opportunity, it's important to understand the support that a founder has. Being a founder is generally a pretty lonely sport, even if you've got a founding team. There's significant ups and downs. And I think downturns and periods like the lockdown generated by COVID-19 really exacerbate that. So founder support is crucial. You know, it's a very different and difficult time to be growing a business right now. You're probably working remotely. You're probably in isolation from your team. So understanding who's on the team, who the advisors are, what other forms of support the founder has is critical. And then we've got to look internally and say, you know, how do we add value in this situation and to this investment opportunity, and can we do that and ensure that the founder is well supported through a downturn. We also use a tool called Fingerprints for Success, which I won't go to too much detail. The attitudes and motivations of a founder and a founding team, and there are 48 factors that it outputs. One of those is initiation and how much initiation a founder has, and that's one of the factors that we're placing even more emphasis on today.
Which is a bit of a profiling tool, isn't it? It's sort of very focused on sort of entrepreneurship and building businesses as its major lens. Is that right, Daniel?
Yeah, absolutely. So it is a tool that helps founders understand their own attitudes and motivations, understand the founding team, if there is a founding team, their attitudes and motivations and how they mix, and where there are potential blind spots. So it can help founders actually recruit that next team member. As a great example that we often see in early stage, a lot of founders are not very process orientated. They're very much about the vision, about the breadth, about alternatives, and there's not a lot of process to what they do. So technically, we tend to advise founders to bring that into the business as in the first couple of key hires. And it doesn't really matter whether that person's a tech person, a salesperson, or a marketing person. If they have a motivation for process, that can lift the team and bring a quality to the team, to the founding team that they don't already have.
Mm-hmm.
The next factor that we are looking for is cash. Cash is king, and we've talked about using it efficiently being pivotal. If your industry is facing headwinds as a result of COVID-19, then you may be in kind of a survival mode through the downturn. But it's also really important, if you are on a fundraising pathway, to have enough cash to put the foot on the accelerator and thrive once the downturn is over. And that's because investors, and in particular later stage investors, invest in growth. So the fact that you have survived only is not that attractive. The ability to grow and thrive is really, really important. So conserving cash during a downturn, if you're in an industry that's particularly affected, is super important at this stage. The next factor we're looking at is financial projections. Early stage companies' forecasts are generally full of unvalidated assumptions and financial projections, and they usually can't be relied upon. We generally review financial models to understand how the founder thinks about the business, and how they kind of translate assumptions into expenses, which then drive revenues. We're not actually looking at the numbers, and we're certainly not going to hold a founder to a 3 or 5 year forecast at the early stage, because we know that macro conditions will change and the business will change based on customer feedback, based on founder observations. But in the short term, there is more of a scrutiny around use of cash and expenses. Most companies will struggle to gain new clients, be that consumers or businesses. So, we really kind of discount aggressive kind of ramp forecasts that we generally have seen in the last 2 to 3 years in today's environment. Sales cycles are likely to be longer as operating budgets of customers are cut, and a more measured approach to hiring is likely to be taken. So we factor that into our analysis of a business model. How much of your funding is going to come from short-term revenue ramps? Is that actually going to happen? And are you able to actually get to the position you need to prior to your next raise or prior to being profitable in your model?
It's really interesting the way that you're focusing on that, because venture capital traditionally does focus very strongly on the numbers around holding people to account. But it's probably, as you say, more later stage when there's probably greater certainty around, what the forecasts are going to be. So it's really great to hear how you sort of look at assessing the business performance and keeping the accountability of the owners and the founders to their predictions around expenditure, rather than just sort of broad forecasts that could change based on multiple factors.
Yeah, as I said earlier, it's really hard for us as an early stage investor to get that sort of data where we can have confidence around assumptions that the founders are making. When a company's been running for 3, 4, 5 years, you start to be able to build that type of data set, and the company's probably got product market fit, where the founder can hopefully say with some certainty that if I spend $1 on marketing, it's going to lead to $5 of revenue over a certain time frame. We just don't have that type of luxury, and the founders that we speak to definitely hand on heart can't say that. So we need to view financial models through a slightly different lens.
Cool.
And then I think the last thing the second last thing that I'd like to focus on is resiliency and innovation. Obviously, in times of downturn, founders have probably already made some hard decisions through the first half of this year, and understanding what decisions have been made to date is really important for us. If founders have been in an industry that has had headwinds, and they've kind of gone along business as usual, continued to spend the same amount of money, that's probably not the rational and right thing to do. So there's had to be some innovation. There's probably been a necessity for some sort of pivoting. We can see from the charts on screen that, most companies, more than 50%, have done something to their business model over the last 3 to 6 months as a result of COVID, and that makes 100% sense. And we'd expect to see that. If we don't see it, we're probably, there's probably an assertion around the founder and their kind of realistic expectations for the business. So that's one of the things that we can look at now as a result of the last 3 to 6 months.
Which is just sensible. I love the sensibility about what you're talking about, because it's not having unrealistic expectations on businesses, and also, going through difficult times we're going through at the moment. So I think that's it's a great point that should be highlighted.
Yep. And then the last point that I'd talk about is valuations. Obviously, a sensitive point for many founders and businesses trying to raise capital. And we do have some data already from PitchBook that's showing the average kind of valuation is probably down about 20% from 2019 to 2020 up until March, and likely that's probably continued a little bit. And it makes some sense, right? If growth rates are coming down, and if companies are going to need more time to reach the same objectives, it's likely that investors aren't willing to pay the same type of multiple as they were back in 2019 when conditions were very different and we didn't have the kind of headwinds we do from COVID-19. So I think both founders and investors need to be reasonable around valuation, knowing that macro conditions have changed and that growth rates just aren't going to be the same, at least, probably in Australia for the next 6 to 12 months. And that's kind of where I'll stop, Matt, and over to you for any further questions.
Yeah, if there's anyone that's got questions, just put them into the quick Q&A. But just on that particular last point there around what do you sort of see from a personal viewpoint, because none of us, can predict the future. But and maybe just stop sharing your screen, Daniel, so then we can have a bit of a chat. Just in terms of what do you sort of see the economic outlook for businesses, either in the startup community or just in general from your perspective? And obviously, it is a personal view that I would like to ask.
Yeah, I mean, it's an interesting question. It feels like Australia's certainly done well, relatively speaking, versus our counterparts in the Northern Hemisphere. And it feels like there will be a reopening in Australia over the next, call it 2 to 3 months, and business will resume in some form of normality. So we do expect startups and technology companies to start to be able to sell and market a little bit better than they have been able to over the last 3 to 4 months. Obviously, in times of downturn, later stage companies or more mature companies tend not to spend on innovation, and that's an opportunity for early stage tech to really gain market share. So if they have been conservative with capital, if they have used it efficiently, there's an opportunity to really thrive over the next 6 to 12 months. It obviously depends on the industry that they're in as well.
Are you seeing a greater volume now in relation to people seeking capital, or less over the last, sort of say 3 to 6 months?
It's probably, we did the numbers just about a month ago. We're probably seeing the same volume. what we're seeing, I guess, is a little bit of a bifurcation in the type of companies coming to seek capital. We've got kind of the standard growth companies and companies seeking capital. We are seeing a little bit more companies that are seeking a bit rescue capital and a little bit more distressed. And that's not a space that we play in, but we've definitely seen more of those type of companies. And there are obviously investors that are willing to play in that space, but that's not what we do. We're looking for companies seeking growth capital at an early stage.
And what about on the investor side of the fence? Are you seeing a restriction in capital availability, or are you seeing people actually gravitating towards this as an alternative asset class that they want to invest into?
At the seed stage, I think funds are still investing. They're taking a longer term view as we are, and we made 3 investments, I believe, in March, and hopefully we'll be able to announce 3 or 4 new investments in the next 2 to 3 weeks. So we're taking that long-term point of view and investing in companies that are resilient through the cycle. More generally, I think with our club members, we do have some insight into angel investing. And with any period of uncertainty or downturn, there's a rise in risk aversion. So either people are holding off on investing or they're investing smaller amounts. And I think, having spoken to other funds and angel syndicates across Australia, that trend's probably pervasive.
Yeah, which would make sense. I think we saw, a very tightening up of everybody with the complete uncertainty when we were headed into this. But I'm sensing a bit of a normality, which then opens up people's confidence to a degree. So I'm seeing a little bit of that at the moment, but it'll be a watch and see. So it's pleasing to hear that the investments still continue on, because it's required to continue on with the growth of our businesses and the economy. So it's pleasing to see that that's still occurring, because obviously that's what we're here to do, is to try and help our businesses and our business owners continue to thrive, because it actually drives the economic landscape of the country, which is great.
Absolutely, and that's why we are taking that longer term perspective, and are happy to back great founders, fundamentally sound business models that are resilient through the cycle.
And I reckon that was a great summary, just what you just said then, is that you're backing founders with businesses that have got something that is required. It goes back to the law of economic law of demand and supply. You want to make sure that you're backing businesses, and they were great examples today of diverse businesses and business models, but they've all got a strong founder, as you say, and strong vision, and then also a product that's going to be in demand, not only now but also in the future. So it's been a really great insight today, Daniel. I really appreciate you sort of taking your time in doing this. So I'd really like to thank you for your time today. And it's always, as I said, I love listening to your insight, because I think you get to look at 2,000 businesses a year, which is a phenomenal statistic. And I think you're investing to about 10 or 15, I think is the stat, if that's right still.
Yeah, absolutely it is. So yeah, we probably invest in about 1% or just under 1% of the opportunities we see.
Yeah, so it's great. So, to have that sort of data or information, I think is very powerful. So once again, thank you for your time. And once again, thank everybody for, listening in, and also listening to the recording, which is also available post this live chat. So thanks very much, and we'll see you next week.